afternoon. Welcome to a very special edition of Indianomics on the just announced GDP numbers. I'm Latha Venkatesh. The Indian economy has grown in the second quarter of the current year by exceeding all expectations. The total GDP riding on a fillip in the industrial sector has grown at 8.2%. This is the fastest rate in about 6 quarters. We are going to analyze this data over the next half an hour. Already the bond market has analyzed and come to the conclusion that with an 8.2% second quarter GDP growth and the 8% first half GDP growth, it is extremely unlikely that the Reserve Bank will cut rates. We have seen a 5 basis point rise in yields across the curve, whichever instrument you take, 5-year, 10-year, old 10-year, new 10-year, there has been a rise in the yields. So that's the most important impact after the announcement of the GDP. We don't have the equity markets trading now, but if it were, then you could see perhaps a 21-gun salute, a huge rise even in the equity markets. But to analyze the economic implications, I have a panel of economists joining me. Kaushik, the Chief Economist, India and South Asia at Deutsche Bank, Sakshi Gupta, Vice President and Senior Economist at HDFC Bank, and Sameer Narang, Head Economics Research Group at ICICI Bank. Gentlemen and Sakshi, thank you very much indeed for your time. Sakshi, I come to you first. You had a very interesting report that India's incremental capital output ratio has also gone down. Now, when you look at these numbers and the gross fixed capital formation number, which is also very strong, rising at 7.3, what's your outlook for the second half? Do you think we are going to produce at least a 7% for the current quarter? You're on mute, I think.
Sorry, yeah. Am I audible?
Yes.
Yeah. Latha, today's GDP numbers, of course, are a very big surprise, as you highlighted, beating our estimates as well. We were close to 7.2. Look, there are a couple of things. I mean, we can debate why these numbers are so high. Of course, it is coming on a low base from last year where real GDP growth was, sub 6%. We know that there are deflator issues also, which are inflating real GDP growth numbers, because in nominal terms, nominal growth was just about 8.7%, slightly lower than what we saw in the first quarter. But that aside, I think this data does tell us a couple of things. One, I think on the consumption side, there is this momentum that has continued to pick up in the second quarter. I think a part of this is being led by the rural economy, as well as, I think, some improvement in urban demand. On the investment side, yes, of course, I think a lot of the heavy lifting has continued to be done by the government. But I think that if you look at some of the other indicators, corporate bond issuances this year, etc., and some of the feel that we are getting on the ground, there is beginning to be some positive signals around, in certain sectors that private capacity expansion is also increasing. Okay. Right? Clearly, the manufacturing number coming in above 9% for this second quarter is again a very reinforcing and positive signal, which indicates, that manufacturing capacity as well as production continue to be on the positive side despite the tariff threat that India faced.
No, I take your point. Manufacturing is standing out as a very strong number, though, to be fair, my poll also said 8.9 for manufacturing. The surprise has come even in finance, real estate and professional services, coming in at a growth of 10.2%, as well as public administration, defense and other services, which has come in at 9.7 over a base of 8.9. So it's an extremely strong growth despite government consumption going down. Kaushik, what would you pick out as the biggest surprise in the number? I got only one person coming to 7.7 at least, and that was Soumyakanti Ghosh of SBI. He gave us a number of 7.7, but said that he wouldn't be surprised if it were 8. But otherwise, that was the best number we got. What is the surprise?
Latha, you forgot to mention my name. I thought I gave much earlier.
No, you never answer my poll. Kaushik, you don't answer my poll, so you're not in it. Go ahead.
Okay, so I had predicted 7.7 long time back, and I had also written that it will be above probably 8%. I was a little scared to give above 8%, but it was very easy to forecast it because it's not very difficult. Because if you get your nominal GDP growth right, and I had a forecast, now I can tell you can see in my report, it was 8.6%. And all you had to do is take the deflator, which was coming at 0.5%, because in July, September, WPI inflation averaged 0% and CPI averaged 1.7%. So if you apply a 70-30 ratio for WPI versus CPI, you would have got a deflator of 0.5. So 8.6 minus 0.5, you would have got to that 8% handle or something. I was a little conservative, so I gave 7.7, not knowing how.
To be fair, Kaushik, even our poll indicated an 8% nominal GDP and a 7.4% GVA. So even the people who were, 7.4% real GDP. So it was almost 0.5% deflator even as far as our poll was concerned. The deflator perhaps has been correctly calculated by most people. There is no taking away from the fact that the overall economic growth, despite the deflator, notwithstanding the deflator, has been a positive surprise.
Yeah. So definitely, I mean, we are not saying that this is not a good, number. This is a good number, but it was, at least to me, it was known that it will come strong. One is because we are calculating year on year. Remember that. So last year, July, September was 5.6. So the base was very favorable. The second is the deflator issue. We knew that it was a question of, whether you will get your nominal GDP, forecast correct or not. Yeah. We had it at close to 8.6. So that came at 8.7, I think, actual. But, the half empty story is about the nominal GDP growth having come down so significantly. And that has a lot of implication for whether it's tax collection or whether it's, other ratios like earnings estimate in the equity markets. These are all based out of, your nominal GDP growth. Nominal GDP growth falling so much is not a very good sign, and it'll have its own issues with debt GDP, flattening out. So you have to keep this in mind that this is probably one of the lowest nominal GDP growth number that we are going to have. And in FY26, we'll probably have nominal GDP below 9%, which is not a very good, story. And remember that, going forward, what can happen if that nominal GDP doesn't increase too much. I'm just talking about next year. Yeah. And suppose your GDP deflator comes up, then your real GDP gets squeezed and comes much lower, right? So you should not be just seeing the real GDP and saying, because your real GDP and nominal GDP has become almost same. Is that a good thing? That is up to debate.
Okay. No, I agree with you that the nominal GDP is among the lowest numbers that we have seen in some time. But just now we are getting the tax numbers also. The October tax GTR, gross tax revenue, is up 13.2%. I don't know the April-October number yet. I haven't done the calculation. I only did for October. At the moment, it's not reflecting in tax. And we should also remember that after the government announced the budget, we then had the final numbers for last year, and that reduces the asking rate of nominal GDP to just about 8.1%. So at the moment, the fiscal deficit is not in any danger. But as you say, anything else dependent on nominal GDP, like the final tax collections or even earnings of companies. The company's earnings are only going to depend on the total amount of goods and services extra they produce. That creamy layer of rise in prices is not going to be available. And that might bring down earnings growth, which is a worry. Sameer, would you agree that, the growth is genuinely a surprise, but the nominal GDP can have its side effects?
No, Latha, I agree. Nominal GDP has its own side effects. But when we look at a number of other nominal variables, as you are pointing out, and as was stressed by Kaushik as well, what you see is that credit offtake is picking up. It's 9.7 lakh crore this year versus 8.1 lakh crore. Overall credit growth on YOY basis is also much higher now. It bottomed somewhere around May, which was sub 10%. It's now around 11% plus. And when you talk about corporate results, they are also, even if you exclude the variation which is given by the OMCs or the refiners, overall revenue growth has picked up, overall earnings has picked up, operating profit has picked up. So it seems that we have bottomed out, and we are gradually seeing an increase in momentum, improvement in various growth indicators. There will be headwinds and tailwinds. Tailwinds will come from consumption. Very strong non-oil, non-gold imports, very strong vehicle sales, which we are seeing both in two-wheeler and passenger vehicles. But exports could be a headwind, which will ensure that growth is not as strong as we would have liked. So ideally for, a growth to go up to 8%, on a sustainable basis, what we require is much higher exports. And in the last quarter, we had seen, fairly good export growth. This quarter may not be because of the 50% tariff.
Yeah, take your point. And Kaushik, to come back to the fiscal impact, I told you the October number looked strong, but the April-October gross tax revenue growth is only 4%. So we could have a problem. Already capex spend for the month of October has been pretty low. So one doesn't know if there will be other repercussions because of this. But while we want to discuss what happens in the next policy, the immediate question is what will Reserve Bank do? Sakshi, your view, do you think you can really go with a cut with an 8% first half GDP?
Look, I still think it's a close call, Latha. I don't think that at this stage I would completely discount out the possibility that, of a rate cut in the December policy. It's really how you view this data, right? One of the things that we haven't discussed in this data is that a lot of the manufacturing growth or real GDP growth that we are seeing is because there was so much front loading, right? And so much production ahead of the festive season that is driving some of these numbers, right? A lot of that now starts fading away as you move into the second half of the year. Particularly on the export side, where we have still not seen the impact of tariffs play out, and it's just starting, right? So I think if you start looking at forward-looking numbers for the year, be it in real terms on a quarter-on-quarter basis or in terms of the nominal growth that we have currently, I think there is still case that one can make and say that, look, RBI might be more forward looking and think about, the inflation is providing them room to perhaps bring down the policy rate a little bit further. So I would still say it's still a close call.
What's your expectation, Kaushik?
We've been going on with the rate cut call for some time. We think RBI definitely should cut in December. These GDP numbers were known that it will come on the stronger side. But look at the forecasts for October, December, January, March, April, June that RBI has given and the consensus estimate that we have from the economist community. It's all at 6.3, 6.1. And I saw April, June next year. Now it's looking like close to 6% from the collective wisdom of all people who have submitted their surveys, which is basically telling you that the high base of this year, for whatever reason, whether it is deflator or other issues, next few quarters, you have a headwind of growth falling closer to, below 6.5%. And RBI's forecast is showing the same. If you look at FY27 growth forecast for RBI, it's sitting at 6.6%. They might revise this year's growth forecast higher. We already are at 7%. RBI is at 6.8. Probably December, they will raise it to 7% or slightly higher. But next year, their forecast is 6.6. If they're not going to change that, you're going to be below the potential growth rate. And, the base of this year plus the deflator story that I told you, if inflation picks up, then real GDP automatically stabilizes. You're going to be, from a forward-looking point of view, much lower than where you are today. And monetary policy is all about forward-looking, projections. And the tariff deal is still not done. We are now hearing that probably by the end of December, we'll get a deal. We thought it will get done by November. Already the stresses are getting reflected in the September-October trade data. GST has been a good story for October, but beyond October, we need to see whether the momentum sustains. So there are lots of headwinds which RBI will have to keep in mind. And at the same time, RBI is an inflation targeting central bank. You have inflation close to zero. And going forward, RBI will revise the inflation forecast down surely for this year. Next year also, RBI's forecast is 4.5%. Whereas the consensus estimate of economists are close to 4%. So whichever way you look at it, I think there's a room for 125 basis points rate cut. And I'm not saying that, you have to do it. But the point is, if you're not doing it now in December, then the case for doing it either in February or April, it's too far away and, it loses its own whole relevance. And remember that February end, we will get a new set of GDP numbers. Everything will change. So all these forecasts that we give will not matter because the methodology will change and what comes with the new base, anybody's guess. And it will start with the October-December GDP numbers. So all these forecasts that we have may, to some extent, may be not that meaningful. But whatever data we have till now, you look at the forecast forward-looking either by the economists or by RBI, everything is below 6.5% for the next few quarters. And that merits a rate cut at this stage, not taking any more risk.
Okay. Well, I'm now beginning to doubt this whole idea of forward numbers altogether. Forward numbers, which were forecast in April, were 3.7% inflation. We are at probably 1.9, not even 2%. The forward numbers were 6.5 first for growth and then 6.7. But we are probably definitely going to end up at least at 7.2. So, I mean, if you keep looking at forward numbers, then the backward, when you look back, the decisions look wrong. The same question to you, Sameer. Do you think with the growth at 8% and inflation, inflation is below expectation, growth above expectation, it's the happiest position a central banker can be. Does he really have to tinker with anything?
No, I think, first of all, I agree with you, Latha. We need to show some humility here. Numbers for all of us have been very different from what we thought at the beginning of the year. In fact, we have revised our growth numbers twice. And honestly, today also, we will revise it higher, somewhere in the range that you spoke about, 7.2 or slightly higher. Because October numbers are looking slightly better, because consumption is holding up much better than we thought earlier after the GST cuts. So that is holding up well. The second thing is on inflation, you're right. Inflation is much lower. We tend to revise it again every 2 months on the lower side. But next year inflation, we believe, will be around 4%. So I think on this growth number, RBI can easily say that growth is holding up. We don't need to tinker anything, as you are saying, as of now. The second part, which we should remember, is that this is the second year of BOP deficit that we will be looking at. So naturally, you are looking at much lower liquidity or savings flowing from abroad into India. So the natural equilibrium of interest rates actually has to be higher than lower. And the third thing is that the currency is weakening. That is also inflationary. And right now, transmission might be perhaps a little bit difficult, as credit deposit ratio has been inching up. It's around 80.2 right now. And we should remember in 2019, when we were cutting rate, injecting liquidity, the credit deposit ratio was around 75. It went all the way below 70 during the pandemic, and then it went up all the way above 80. And now we're also again above 80. And this is a busy season. Wholesale deposit rates are any which ways going up. So I think the focus should be 83 basis points of transmission has happened on the lending rates, on the fresh lending rates as of now. The remaining can be transmitted through, more open market operations or swaps, or the way RBI wants to inject liquidity in Q4 in order to ensure transmission. And if, inflation and growth forecasts do hold true later on, if growth does slow down, they'll have room to cut, because inflation any which ways perhaps will be lower on the lower end, as we are revising it lower any which ways every 2 months.
Okay, no. So what's your bottom line? Cut or no cut?
No, I think we think they can avoid a rate cut right now and do it later if need be. Okay, no need to do a rate cut right now.
That is, I think, two nays. I don't know where to put Sakshi. Yes or no, Sakshi?
I think, Latha, that they should cut the policy rate.
Okay, so that's 2:1 in terms of a cut. It will be a divided house. We must remember that it's a fairly dovish Monetary Policy Committee. They seem to have gone along with the no action last time only because the Reserve Bank said there is place. So it's quite possible that the majority forces the Reserve Bank's hand, but it's going to be a very, very difficult communication. But the more important question to ask is whether India's potential growth itself is higher than we are all estimating. Remember China in the 90s, when they were harvesting their demographic dividend, were producing over 10% growth. Maybe we are in the 8% threshold and we are unable to believe that we are so good. That question to my economist panel after the break. Welcome back to our very special Indianomics on the GDP numbers that have just been announced for the second quarter. It's a stunner at 8.2%, but the nominal GDP makes us a little more humble. The number comes in at 8.7, a tad lower than the 8.8 that the economy scored in Q1. That has its own implications, of course, for corporate earnings and for the government tax collections. I've been speaking with economists Kaushik of Deutsche Bank, Sakshi Gupta of HDFC Bank, and Sameer Narang of ICICI Bank. Gentlemen, and Sakshi, thank you very much for your patience. Sakshi, would you believe that, we have to perhaps wake up and say that this economy is growing faster than we thought? That the potential is actually maybe north of 7?
Well, Lata, not to get biased by recent numbers, I still do believe that India's potential growth is perhaps close to 7% at this stage. Look, we have to look at a number of indicators. And in my recent report, I, look at capital productivity across segments and, at the aggregate level. So yes, capital productivity for us has gone up, right? But a lot of that improvement is coming in, sectors like, power, construction, services. I think the manufacturing sector has actually seen a worsening of productivity over the last
Yes.
5 years. Combine that with the fact that your labor productivity, I think over the last decade at an aggregate level, of course, there will be sectors that would be doing better, but labor productivity also hasn't improved much.
Okay.
Right. So I think that just from that fundamental perspective, I think that yes, there is potential for us to kind of improve, and move from the 7%.
You have to wind up quickly. We're out of time.
Potential grow to 8%, but I don't think that we are there yet, just based on these productivity metrics.
Okay. We have only a couple of minutes left, and I want a poll on where you all see Q3 and full year GDP. So let me first do the poll and then get to other questions. Kaushik, what's your Q3 and full year number?
So we have Q3 at 6.5, and for this year we have 7%. Next year is at 6.5.
But would you be revising after looking at this number?
I have to see the details, Latha. As you know, the discrepancy portion, whether it has subtracted or added, how much CSO could explain. Net exports, you'll see, has subtracted a lot from growth, with imports being much higher.
Yeah.
So how much CSO has been able to explain out of that C plus I plus G, and how much, net of discrepancy, how much is the growth, all that goes into,
No, I agree with you. Actually, discrepancy is high, and so is the net exports that has to be subtracted. So, yes, you'll have to do your math. Sameer, where are you standing for Q3 and full year?
I think Q3, we will revise it higher, given consumption is very strong, so around 7. And Q4 will be around 6.5 because of the fiscal compression. So the overall year number should be 7.2, 7.3.
Okay.
That's the back of the envelope calculation, but we come with details.
Okay, so 7.3. Sakshi, your full year number?
So for the full year, currently we're at 7.2, but I'm going to revise it higher after this GDP number. So I think it will be closer to 7.3, 7.4.
So you may be at 7 even for Q3.
For Q3, we are at 7, slightly higher than that, given the momentum we've been seeing.
I just got about 30 seconds for Kaushik and Sameer. Kaushik, would you agree that maybe we have to rethink the potential of the economy?
No, potential growth rate, we always calculate, at 7% when we do all this Taylor rule formula calculation. What I can say is that after COVID, we felt that the potential could have fallen to 6.5 or lower, but that has not happened because of government supply side reforms. So I think 7% is a good number to work with. As Sakshi said, don't get biased by just the few last quarter's numbers. And remember, once we get the new GDP series with all this calculation, all this discussion will gain more traction. So at this moment, 7% is a good number to work with.
Fair enough. Sameer, you get only about 10 seconds. Would you believe that India's potential is higher than we are estimating so far?
No, as of now, it's 7. But if we can get our exports going, it'll be 8.
Okay. Well, at the moment, that's the difficult part, whether we'll be able to get our exports growing at all. But let's wait to also see whether all these numbers get modified seriously when the new GDP series comes out on February 28. Sakshi, Sameer and Kaushik, thank you very much for enlightening us and reading through the numbers, reading between the numbers. The GDP, second quarter GDP is a stunner at 8.2. On that note, we wrap up on this edition of Indianomics. Thanks for watching.